colder than 31 degrees.
Fantastic, great. Okay, I'll let you take it over, Dave. Thanks so much.
All right. So there are three of us. Is Paul also, you want to turn yourself on?
I am still blocked by the host on the video, trying to.
Marty, open Paul, please.
Marty, please.
Okay, view.
There we go.
All right. Okay, there we go. All right. I guess I'd like to, Bill, why don't you introduce yourself? Talk a little bit about your background, and then we'll swing back around and we'll talk some questions through for each of us. So
sure. Thanks, David. My name is Bill King. I'm currently an investment banker. A little background I'm here in Dallas. I have over 20 years of capital markets experience. Vast majority of that experience was in senior debt in the commercial lending side. So I worked with large banks. I started at B of A and Chase early in my career, worked my way into regional banks where I was more of a credit executive, and then moved into smaller banks where I was a market president, and learned over that experience that there's all sorts of different credit boxes within senior debt as well as non-bank lenders. So went out on my own about 4 or 5 years ago, did some senior debt placement, and then got my investment banking license to do sell side and buy side M&A as well as capital raising. So that ties in, I know, with a lot of what's going on today with we heard in some of the earlier presentations of challenges in the markets now that we had the bank failure, and just things that have been challenging over the last few months. But that's a little bit about my background. I've also written a book called the No BS Business Finance Guide, if anyone wants to look it up on Amazon. And always looking to help lower middle market businesses, either they're interested in buying companies, selling companies, or raising growth capital. And glad to be here.
Okay, thank you. Prabhu, you're representing us in the room. We put our handsome guy live. Introduce yourself, please. Hi.
Sure. Great to be here. 20 years of classic investment banking, sell side and buy side, and some corporate development. Tech and tech-enabled businesses, middle market, cross-border valuation arbitrages is a focus area as well. Co-founder of Seth & Lucas, which is a Hong Kong headquartered iBank, been around for 15 years now, with about 120 people globally spread. Most recent rodeo is co-founder, president, and CFO of Stonebridge Acquisition Corp, which is a publicly traded vehicle on the Nasdaq, ticker APAC. Dallas-based, I did 15 years of one-way commute from Princeton to New York City, 2 hours each way, so got burnt out, and among all the East Coast transplants, moved into Dallas about 5 years back. Wharton alum, wife and 2 kids, based out of Dallas. Great to be here. Thanks.
Okay, and you're going to tie in the conversation about SPACs and some other pieces, which will be interesting. Paul, will you introduce yourself?
Sure. I'm Paul Whitley, and I own a company called C-Suite Support. We are a group. I've got 8 CFOs, 2 controllers, a couple of accountants, and we work with small $5 to $40 million companies to provide them CFO services. Background early on, multi-billion-dollar company, over 1,000 locations, SEC reporting. Moved into a private enterprise to run a small retail company, growing it from 6 million to 180 million. And then crossed over to the dark side to be a lender with a bunch of these guys on this panel. So for 15 years, I was a lender with commercial lending. And in 2008, the hedge fund where I was a director failed. And at that point, I became an interim CFO. And about 7 years ago, learned that there is such a thing as fractional CFO, and started that process, the best move that I ever made in my career. Between my 2 partners, myself, we've done a little over 300 M&A transactions, both buy and sell. Our company is not set up to do that as a business. It just happens to fall in our lap as we go through these transactions. So we're constantly in a company that is wanting to sell or they're wanting to buy, and that's what put us on top of here. We're also a national sponsor of Exit Exchange Planning, XPX. So we're introduced to transactions through that opportunity.
Okay, thank you. I'm David Nair. I have a background in technology. I have about 800 inventions in 9 domains, but I'm also an MBA and was originally trained as a mathematician. One of the things I was part of was SPSS, one of the first statistical software programs, which will drive, I think, some of the work we've already heard here in AI. I've participated in 5 of 8 domains of AI as an example. But I've also spent 5 years at Booz Allen doing a lot of very large transactions and transformations of companies, including some of the larger tech players. And I had a role at Dell as a manager of their business development, working for Michael back in the 90s. Subsequently, I've been a part of 47 technology companies and 18 funds working on how do you innovate and how do you get funding to it, how do you price it well, and support the success of it. So let's swing around to I'm going to just ask a very general question. Any of you can answer, which is, what is the role of M&A and why is it on this agenda talking to family offices?
I'll be happy to jump in with that. At least in my role in M&A, is a lot of what we're doing is aligning buyers and sellers or clients that need money with capital sources. We're in essence a matchmaker, we're an intermediary. And that's important, I would think, right now in the current markets, because when you have the flight to safety that's happening with a lot of the banks, where you're hearing that the senior debt lenders are tightening up their boxes a little bit, which is creating opportunity for private lenders and equity sources like family offices and venture capital and private equity. A lot of times the people who need the capital don't know where to find it. And that's where we all come in. And I'll turn it over to Paul or Prabhu and see what their thoughts are.
So Prabhu, specifically, you said there's been a meteoric rise in technology sector, which is now getting trimmed. Is there still an M&A role in there? And how do you find it?
Well, there's still a lot of money out there on the shelf. There's a lot of dry powder. There's companies that are trying to put their money to work. It's sitting idle, and they need to go with it. If it's a good product, tested product, where having been in the lending side, I'm integrated with a lot of lenders all the way from seed money to each one of the levels going up, and then obviously into the bank levels. So we all know, it's been discussed today, the banks are going to be a little more hesitant right now. The family offices and other groups are going to be a little hesitant to see the shakeout that's going to happen. We all know that there's going to be some more hammers to fall down just to follow this. So I think there's going to be a 30-day window out there of people waiting and seeing, but no different than when my hedge fund failed during the last one of these suckers. That was pretty good size. We did come back around, and it did take a while before we got out there, and it took me about 18 months to start getting securitizations going again, primarily in the subprime market. So if the subprime can take it down and come back in 18 months, that was huge. This is not an 18-month turn down. This is a bank that's dealing with issues of that bank, and there's other banks, and I'm connected to banks here in Dallas that I've had conversations over the weekend with bankers, and they think there are going to be a few more to fall, but again, it's poorly managed banks or poorly managed investments that are putting them there, not a crisis.
Okay. Prabhu, pockets of M&A value?
So I think, thanks to COVID, I think we've all had significant consumer behavior changes and enterprise investment patterns in technology, right? It's a change, that's going to last forever. While the VCs and the private equity are chasing the sexy part of the technology, I think the unsexy part of tech is where I think the money is, the value creation is as well. And one of those will be tech and tech-enabled services, right? These are pockets where you could jump in and at a lower scale at about 6 to 12 multiples, and obviously you have exit multiples going from 12 to 20, 22 multiples, especially if you're lucky enough to go public, right? You're not paying insane value, and these are EBITDA multiples, sorry, it's not revenue multiples. So I think from that perspective, I think the unsexy part of technology is very interesting. Eventually the money, the spend, everything is going back into the Fortune 500 companies. So the investments are also less risky. I think from that perspective, I'd probably look at that particular market. Going back to your first question on M&A, I think it's a surprise that family offices have not been very active in some of these pockets, especially again tech-enabled services and in general services markets, because the two-pronged approach there is EBITDA expansion, EBITDA multiple expansion. On top of it, you're putting corp dev and M&A as a catalyst to get out of the business in about 5 years as an exit play, right? These businesses lend themselves very well, to those kind of a value creation and value investing. So I think there are definitely pockets, and I think family offices need to be looking at it. One quick example is a very recent transaction that one of our offices consummated, which was the Dell family office, which took a lead in West Monroe Consulting and Veris combination. It was a three-way deal where Dell actually went into a fairly fundamental services business. So there are some interesting examples in the market.
Bill, do you want to talk a little bit about the market layers where you see M&A fitting with different sizes?
Yeah, it's interesting when you look at, both on the debt side and on the equity side. For example, on senior debt, which I think Paul can relate to, and he can comment on when I'm done, is as the different segments tighten up, you almost increase portfolio quality for the lower segments. So for example, when the big money center banks are tightening up their credit, which is happening right now, some of the businesses that are being thrown off from there are going to more regional banks. And so those regionals are getting some better loan quality than maybe they had in the last few years. And so they're also tightening up. So some of their credit is falling off to more of a community bank. And then that's creating opportunities for SBA loans as well as for independent lenders, like we were talking earlier, of non-bank lending sources. And on the equity side, it's similar in that as the funds that have been gobbling up a lot of these deals in the past are tightening up too, it's creating opportunities for some of the other funds to have increased quality because maybe they were doing weaker deals because they couldn't find any deals. And now some deals that are a little stronger are coming to them. So you almost see an increase in portfolio quality all the way around. And then, the deals that were lower end that were getting done by some of the lower end of the market are just having trouble finding equity partners at all. And I'll turn it over to Paul with his great background for any additional insight he has.
Well, I have to follow that strongly in that, we've seen the trickle down effect that we saw back in the 2009 to 2014 range. And it went for a while as the banks, and particularly the bigger banks, that's where you're going to see the biggest tightening of the drum. I've got 8 transactions in with local community banks right now. I make a practice of trying to move them out of the big ones, just because now you've got a banker that you actually know the name of, and you can call them, and they'll return the phone calls. So I've been in that process of moving them out ever since the administration changed. Let's get some banking situations, and I can usually get in there for 50 basis points over where the big boys are. So I think you're going to see that same trend just continue. And I agree with the SBA, even though the little guys will probably go a little more stringent on the risky types of transactions that they might have put on the books with SBA. That's going to continue to be funded. So you're right. It's just going to be a shift of where it's funded as opposed to can it be funded.
So I want to bring this back to a different thesis in my head, which is, as you scale down, you have more M&A activity available for family offices, which might be in the middle or lower market end of that, right? So again, this potentially more family office opportunity as well. Is that right? Would you nod to that?
Absolutely correct. And the issue that the family office needs to have is, as they get better opportunities, they may see things in verticals that they have not considered before. And they need to pull in some expertise to make sure they know how to do that. Our previous speaker was in subprime. I funded over $2 billion in subprime and never had a loss. It is such a strong market. And I also did a 25-year study of the subprime market when I was trying to sell a large billion plus, multi-billion plus portfolio, that the subprime market is typically going to go higher in their delinquency, about 2 to 3% over prime. And they're going to go higher in their losses, 1 to 2%, but they're going to come out faster than the prime does. So you're going to get
spread
the
is still
return.
there, and the spread is there because there's value in getting the cash into the opportunity.
Well, the spread is, yeah, the spread is greater. Because of that, it's right in the family office return trend.
Yeah. So let me, Prabhu, I'm gonna swing back to you because I promised some foreshadowing around SPACs. You want to just talk a little bit about what you're doing there and how it might fit with the conversation so far?
Sure. I think there's lots being joked and ridiculed about SPACs in general. Given some of these $10 stocks which are trading at cents to the dollar. But I think one of the fundamental issues was the whole world was literally fishing from the same pond. There was no very specific use cases that the SPAC sponsors were following, right? So one of the reasons when we approached the market, we were very clear on it. We said it's got to be a non-US firm. It's got to be somebody who has an advantage and a valuation arbitrage of getting into the US capital markets. So in fact, we went in with the thesis of Asia Pac as the target market. In fact, our ticker symbol is and was APAC, APAC. And I think for a variety of reasons, it makes sense because, good example is the company that we actually eventually picked. It's, there's a saying that SPAC is like, it's like kissing a lot of frogs and eventually getting to one. And that's exactly what we've done. One thesis is also the fact that the middle class in the Asian markets is growing, exponentially. I mean, this is the stat is the next 800 million out of the billion middle class is going to be from Asia, 350 in India, about 300 in China, and the rest of it in Southeast Asia. So these are fairly big numbers. We're talking about 35 trillion of middle class spend in 2015, which is getting into about 65 trillion in 2030. That's like 1/3 of the world economy. So 2/3 of the world population, 1/3 of the world economy, you need a piece of the pie. Good example is India. It started with it took 60 years post-independence to get to first trillion. It took a mere 10 years for the next trillion, a mere 7 years for the next trillion, and it's on track for a $10 trillion economy by most likely 2035, 2040. So it's a fast-growing market. The company that we picked is an Indonesian fintech as a service company. There's no precedent of a fintech as a service company being listed in those markets, in Southeast Asian markets, whether it's Singapore, Indonesia, Malaysia, you can't find one. In the US, you have several of these precedent transactions. So there are trading comparables. It's an easy comp. Those are some of the reasons why that particular use case has worked well in the US markets. And that's pretty much what we're doing right now.
Okay, so just to slow that down, this is a SPAC that provides entry from non-US companies into US markets because there's a surrogate and a pricing mechanism in the US to know their value. And again, provides capital for that market valuation, right? And again, so how does that complement M&A activity? So you're doing both. And is that the discovery of value and the pricing of value? And then I want to open it back to all the participants on the panel around pricing. But I want to start with you first because you were at the end of the line. Probably start that cycle.
So I mean, look, it's technically a reverse merger. The listed company is going and buying into an existing private company, right? To a large extent, you become a Series A filler, right? The company, not every company is growing at 300%, and VCs are lined up to do 70x to 90x in the next 3 years, right? And the Asian markets work very differently, right? So these are opportunities for somebody to come in. This is a company that is let's say growing at about 50% year-on-year growth rates, mature business, 100 million plus in terms of net revenues. I think it's a classic case of value realization here in the US markets. A company like this in the Southeast Asian fast-growing emerging markets today in the private markets is somewhere in the even post all the wash off and trim down, it's really trading between 10 to 12x of revenue multiples. So if you price it right and you bring it to the market, you're giving the US capital markets a little outside the China exposure. Today, you go on Google, the top public listed companies outside China and Japan. In the US markets, you really don't have any fast growing companies. You've got old banks, legacy healthcare companies, and few subsidiaries of governments which are public listed here. There's really no exponentially fast growing companies, the likes of a Mercado Libre or the likes of a Jumia or the likes of the next SpaceX that's coming out from those markets. So I think this is an ideal vehicle for those kind of plays, and it's classic M&A. I mean, you're taking US IPO investors and giving them exposure into these emerging markets at the right pricing.
Okay, all right. So perfect segue on the price question. So the audience asked the question: are we going to see better price and better deals because of the current situation? Any response to that?
Yeah, I'm happy to jump in. One thing that I've been seeing out there is, as we've been talking about the tightening in senior debt, there's a saying by some people in M&A that senior debt drives M&A activity, because that's kind of behind a lot of what's going on behind the scenes with the private equity firms, in addition to the equity they're putting into deals. And we have heard on panels earlier today that you're starting to see multiples tightening up a little bit, getting back down to reality, as people have said. And you're also starting to see longer due diligence periods. So the sellers are having to kind of bounce back because they're used to seeing higher multiples from a few years ago. So I've been seeing more sellers slowing down on the sell side, and Paul can speak on this here in a minute, as far as, but you're seeing opportunities for, like our audience of family offices, you're seeing opportunities for strategic investors that just haven't been able to bid on deals because multiples have just not been reasonable in some cases, are now going to get opportunities to buy into some companies at a more reasonable price that makes sense for their risk tolerance. And maybe they'll work out a combination of a cash and earnout opportunity. I know there's a question about that too, as far as if we're seeing more earnout structures and how they would look. But I bet we're going to see more creative deals because the capital stack is different with the smaller amount of senior debt, and you're not seeing as many unitranche deals. So you're going to see a true senior mezz and equity structure, and probably combined with an earnout to get to the right valuation. And I'll go ahead and give it back to you, David.
Yeah, Paul, that's a good segue into the quality of the deal and the pricing of the deal, which we talked about earlier, you and I at least. Yeah.
All right. Well, in some of the issues that we're talking about right now, time kills all deals. So if you're in the middle of a deal and you're going to be pressed, if you're going to take more than 90 days to close a transaction, that's about the length of time that the suitors are going to be walking down the aisle. And what's going to happen right now is that we're having issues that are being presented to us, and they're very likely to slow down some of the current transactions. So I think you're going to see many of the transactions that are in process right now or being considered right now are going to be delayed. I've got one that was wanting to try to fund by June. We're now in the discussion that this is probably not going to happen until next year. But that's the realization of where we're sitting at this point. The other things we're talking about, if you got sloppy records and you haven't gotten in to do a quality of earnings, or had someone come in and help you get your records in place, and you try to go out for a sale right now, or from the family office, they go out to look at somebody and the records are not in place, that deal is going to be delayed and probably either killed or moved into next year. So you want to make sure that you're doing that. And I'd say along with that, twofold. One is, always have options. When you're in the sell stage, have options. When you're in the buy stage, you hate options. But go on out there, and if you're in the sell stage of any of your product, start going out just to get the practice to see what the questions are that are going to be there. I wouldn't hesitate to do that, but I would reduce my expectation for timing, and potentially even for the multiple has been discussed here. So just pay attention to that.
So let's flip it around, since we're this family office audience. From the buyer's point of view, that means more deals, more diversity, more opportunity, because the constraints on the buying side. Is that right? Again, goes along with better prices.
I think that people are going to be a little more, shall we say, panicked might be the right word, but it's the there's going to be concerns on the sellers at this point, and I do think they're going to be less. Their strength in negotiating is going to be reduced, whether it's mentally or physically in the documentation. Which with the family office, if they've got their details and information in place, I think they can close and get better deals right now, at least for the next 6 months. So be out there looking and make sure you know the industry before you go in there, just so that you can close it quickly.
Yeah. Probably you have something you want to contribute. Yeah.
I think again, as mentioned before, I think there's also cross-border arbitrages in certain sectors, right? I mean, like we are seeing this in the tech sector. While the U.S. Services businesses have been beaten down, I mean, trading at between, you know, the classic tech business, tech services business growing at like 8-9%, you know, 13% EBITDA, at about 12 to 13 times forward EBITDA is where the market is trading right now. But if you look at the complementary European businesses, they're actually at 16x. And if you look at the complementary Indian and Chinese business, they're between 22 to 24x trading in those markets. So what we're seeing from the private equity side, which is probably more likely, you know, the family offices will jump into, is the PEs are actually loading on a platform and they're actually going out bargain hunting and into these markets. They're bargain hunting domestic and they're bringing in, you know, some of these pieces on top of it. European sales offices and Asian delivery centers. And I think that's kind of where the family offices could go to, right? You have a platform and you go shopping into these, diversifying globally from a talent perspective. And I think post-COVID, remote workforce has become, you know, the game here. So I think from that perspective, building that Apple kind of a model in terms of fulfillment is creating a lot of value, and we're seeing family offices jump in there. And it's a great opportunity at these multiples today.
Is a constrained capital stack another problem? So if debt is part of the transaction and debt is less available now that banks are not doing so well, is that also part of?
Well, yeah. So what'll happen is the equity providers, be it family office, private equity, or whoever, just gonna have to put more of their own money in per deal. So they have to decide, you know, you would think you may be a little more selective, where before, if you were getting you're doing an LBO and you're getting, it's like 60, 70% debt, now you have to back it down to 50% debt, 50% equity. You're going to probably be a little more selective in the deals that you're doing. And then you're also hearing, or I've been hearing, that a lot of the private equity firms are focusing on their existing portfolio companies and making sure to keep those strong. So they're doing some roll-ups under platform companies as opposed to going out and buying a new platform. So that's going to affect the way they're doing things. But yeah, in my opinion, and again, I'll let the rest of the panel speak on it, if you're going to be putting more of your own skin in the game and less access to the debt portion of putting a deal together, that means you're just going to have less capital per deal, or less deals you can do. So you're going to have to be more selective on which ones you take.
Again, more opportunity for other players downstream, more deals available, right? Back to that dynamic. Yeah.
Just to add to what Bill said, you know, at the height of 2021, I think we were looking at, you know, the classic 12-13% EBITDA company with about 30% gross margins was tracking somewhere in the 4x turns is what we were getting in the credit markets.
65,000 worldwide M&A deals. I mean, that's the all-time peak. Yeah.
Yeah. And now fast forward, I think we're struggling with companies 50% bigger in size with 2 tons in the market.
This is the last, you know, 4.5 year cycles. We're down to here for M&A activity. This is Price Waterhouse and global M&A. Yeah. Yeah.
Hey Dave, what's the is that 75% of the peak? I can't see the chart. It's not really effective.
So this chart, this is value, and it's about 1/3 reduced from the peak. So 60%.
Okay.
Yeah. 65.
Got it. Yep.
And that's end of 22, and it looks like 23 first half is worse. Yeah.
We have about 5 minutes, but it would be great if people could talk about the impact of, banking, lending pulling back, capital stack. Are people looking at alternative lenders to fill that gap, et cetera?
That's just where we went. Any other comments on that? So this is again the trickle down effect of banking concerns.
I think the general situation, I'm sorry, Bill, if you'll jump in
Go ahead,
there.
Paul, go ahead.
I was going to say, one of the general things that are going to happen is the cost of your transactions going to go up if you're leveraging it at all. Your rates are going to go up, the risk is going to go up, but that's going to cause more rate increases. So if you're using anything more than your own money, it's going to go up. You may have some stress on your own funds of people getting concerns of their own money. You're just going to have that panic fleet, everybody trying to get repositioned and not knowing how to do that. So we're going to go through that for a little bit here.
Yeah, great point, Paul. The only other thing I'll add to that kind of reinforces what you were saying is, I was listening to an ACG panel a few weeks back, and they were talking about what's going on in the market before even the recent challenge with this bank that went down. Is the big winners right now are the private debt markets. People that can get around the BS, for lack of a better term, of the regulated banks, and they can deploy capital in a lending environment where they're able to make a good return and still not dilute too much equity for the person that's either selling their business or they're just trying to raise some capital. I think there's great opportunities for that part of it. And to Prabhu's point, before banks were doing 4 times EBITDA, and now they're scaling back to 3.5. So if you have a private lender to come in on a deal that maybe can do a little better than that, they can get a good return.
In fact, what I'm seeing is more complicated structured deals, but they're private deals. They're less traditionally debt structured. That we have a composite of earn-out equity and private lending with tiered. They're starting to look like a Texas real estate deal, not an M&A transaction.
I don't know if there's other questions here, but I have a question for Prabhu, which is, with respect to the emerging markets, are you seeing an impact, a pullback in banking in emerging markets as well? There's a big article about European banks pulling back and all the problems with Credit Suisse. Your thoughts?
So the cost of capital has risen significantly in those markets, especially in Southeast Asian markets, less so in the Indian subcontinent. And we are seeing, as a result of that, I think 2 things are happening. One, I think the valuations have come down at least by 10 to 15% across the board. And this is not just the revenue multiple businesses, even the EBITDA multiple businesses, which is again a great time, in terms of shopping around for those assets in the marketplace. And 2, there's also been significant decline in the specific verticals in which assets are being, targeted. Right, revenue multiple assets have become a no-no for most of the banks. Cash burn is one of the first conversations of discussion in any transaction in those markets right now. Bank, I think credit markets are going to be tightened for the next 6 months in those markets for sure. And I think as towards the end of the year, we see, a whole bunch of release in those credit markets, returns going up at least 0.5 point. And I think from there on, we're hoping for a better 24.
Yeah, I see capital getting tighter in Europe here, particularly debt capital, and classes of debt are getting tighter as well.
Hey, David. So we only have a couple of minutes left. Can we get to closing statements? And can each person, as they close, talk about what we should be looking out for? Like if a family office is going to be co-investing, any special terms we might want to, ask for as a result of the current conditions that we're in, things along those lines, and, any guidelines for, the structure of a deal that we may, so family offices can only be passive investors in these sorts of deals, right? They can't be the underwriters. They can only be co-investors. They can't sponsor these deals because it has to do with the tax code. So if you guys can lay out some approaches, that'd be great.
Okay. Start with Paul. Let's go. We'll just pick Paul for now.
All right. From the transactions that I'm looking at, you're going to be connecting with the investment bankers, the people that you work through now to find lead people for these transactions, industry leaders that are going out, because obviously these are all private, or many of them are private transactions. So that coordination with the Bill Kings of the world and similar is your inroad to do that. Many cases, when I'm looking for money, I'm going to the guys that can get it off the shelf to support the bank that probably can't do it. Had one today. Bill?
Oh, yeah, thank you, Paul. Yeah, and great point. When you have the capital stack that's changing, where there's a lesser portion available through senior debt, then that's going to create opportunities in the capital stack, like you said, as a co-investor. So if you have a private equity fund that, let's say they were planning to put $10 million into a deal, and the capital stack comes out that there's going to be required, 15, 20 million of equity, they can co-invest with a family office to make up that gap, because at the end of the day, it has to add up to 100%. So if the banks were doing 60 to 70% of the project before, now they're scaling back to 50, that difference has to come from somewhere. And if the lead investor is not wanting to put more capital in, that's a great opportunity for them to come in as a co-investor and take a portion of that.
And potentially in two roles, either as a debt component or as an equity component, right? You can,
yeah, they can even come in as mezzanine debt,
right?
Yeah. Sorry, David, didn't mean to interrupt you.
Yeah.
They can come in as a mezzanine lender behind the senior and make that gap up with a lien on the assets as loan that will have convertibility options, or they can come in as straight equity or a combination of the two.
Yeah. So there are, again, more hybrid deals available.
Right.
Prabhu, take us home.
Yeah, I think one is global is the theme here, especially look at Asia, outside China and Japan. I think there's lots of opportunities. I mean, every 5 to 7 years, there's $1 trillion of economy added. That's insane. You got to have some exposure there, number one. And number two, look at the unsexy part of technology. You still want to be at the verge of cutting edge technology. You want to be exposed to that. You want to be exposed to the growth trajectory in the markets. And the best way to do that is tech and tech-enabled services. Those are still value investing plays underneath there. Suits very well for family offices. And lastly, I think we're all in for some very creative structuring moving forward. It's a combination of earnouts, stock swaps, mezzanine debt, credit, short-term, long-term. I think it's a bunch of stuff that we're all going to put together, but deals are going to continue to happen, and all of us in this room are going to participate continuing in those deals. Thanks for the opportunity.
Fantastic. Great job, guys.